With us now is Jack Ablin, founding partner and CIO at Crescent Capital. We sort of gave away the story in the tease there. You think energy is a place of opportunity right now?
Well, yeah, I'm going to say opportunity and risk. Essentially, what we're noticing is, and not a surprise here, that there is an underinvestment in energy, particularly energy infrastructure in the U.S. And that's just because the future of fossil fuels, as we've learned from policymakers, is uncertain. So to get institutional investors or banks to offer 10-year loans to a lot of that space is not available as readily. And so there are some interesting opportunities for investors.
And a couple of them, you have some names I know. One is Murphy Oil. The other is Targa Resources. Why those particularly?
Sure. Really just playing on the infrastructure. So I think what we see is, look, we have among the biggest production in the world in the U.S., and we're not feeding it. In fact, we're seeing energy prices rise. We're seeing rig counts not keeping pace. So we want established energy players who are benefiting by transportation of energy and storage of energy, which is certainly vitally important. And as the price of that energy goes up, the kind of the postage stamp, if you will, to pay for storage, to pay for transportation will likely go up as well.
Before we come back to another area that you think is of opportunity, I want to talk a little bit about what you see for prices and what will drive prices over, say, the next year. One of my mentors in this game, I was lucky enough to get to know Jack Bogle a bit, and he once explained to me very carefully that the return on stocks is equal to three things. One is earnings growth, two is dividends, and three is the valuation, the price or the speculative part of the return, the price people are willing to pay for each dollar of earnings. You think that people are going to pay less per each dollar of earnings and that valuation component is going to be restrained going forward?
Well, so if you look at why did, let's go back to the last 10 years. The S&P 500 between 2010 and 2020 was up 270 percentage points. It turns out that wasn't earnings necessarily or dividends. 170 percentage points of that move was valuation expansion. The willingness of investors to pay more for a dollar of earnings or a dollar of revenue. And that was largely because the 10-year Treasury rate went from around 4% to 0.6. But now that we're no longer at 0.6, we're about 1.5, and we may be trending higher, we have to take that valuation expansion piece of it out of the equation, which means that now we're going back to just organic earnings growth and dividend yields. Well, what are the best earnings growers? If you're going to pay for earnings, you want to pay a low PE. Those are going to be the cyclicals, the energy stocks, the banks. And strong dividends and quality companies will make up the other piece. So I think overall, we can't expect that the market to rise at the trajectory it has when we've had these lower interest rates year in and year out. But I do think investors who want to focus on earnings yield and dividend yield will benefit over the next 3 to 5 years.